Hello, guys. Welcome back to another episode of Pass Me to Profit. It's Will, alone for today. We're going to change things up every episode, give you some days with a new guest, new topic. We keep things fresh here. But anyways, welcome back to another episode and talking about that, changing things up. In the past, we've been talking about events way in the past, the Black Death, Industrial Revolution. But today we're going to be talking about something new, something very relatively recent, something that almost every single one of you guys lived through, that being the global financial crisis. Now, I know that pretty much very popular event. I know that almost everyone knows what, at least a baseline, but to just give you some background to those who need a refresher or to those who don't know. The global financial crisis was one of the most severe worldwide economic downturns since the Great Depression. It, of course, started through the United States housing and really the financial markets when those really crashed, and that with the U.S. being what you could say as the economic backbone of the world, this quickly spread worldwide. The crisis led to large amount of collapse. Either banks would fall under, or there would have to be bailouts either from the government or from others. Of course, they had deep recessions, and this really altered the entirety of the global financial regulations. Now, we talked about how this from the housing crisis. So what caused that? After the 2001 recession and the dot-com burst, the Fed lowered interest rates to help recover and stimulate economic growth. This meant there was a very easy credit environment. It was very easy for people to borrow, basically. And then, of course, this was combined with something that everyone wants to do, is put people in homes. So the government policies were really encouraging home ownership, which these two things triggered a massive housing boom. You had government policies to put people in houses, and people had the economic means to borrow, because it was very easy to establish that credit to get enough credit to borrow. Now, again, you had low interest rates, so borrowing was cheap, meaning you didn't have to pay a lot back on those loans that you take out. So mortgages were open for a lot of people. Lenders offered subprime loans to borrowers with low income or poor credit histories. Basically, they would give these loans to people who were that they didn't know for a fact that they can get their money back, or the chance that they were actually going to get money back on those loans were not as high as other borrowers. Now, the thing about housing, everyone thinks it's land. The thing with land, it's always upward. Land's never going to get cheaper just because there's a finite amount of it. So very finite compared to other things. So many people bought homes assuming the price would always rise, so that later on they could sell them for a profit. Now, due to this, people had inflated housing prices. Houses were becoming more expensive than they should have been, basically. Because from a buyer's standpoint, you know that later on it's going to be higher, so you're willing to take that hit. From a seller, for the seller, if they're willing to buy high, you're going to set the price high. That's kind of standard. And now this is where it bleeds into the financial sector as well. Just due to securitized mortgages. Basically, these mortgages would be bundled into other assets, other, bonds, stocks, etc., and they would be sold to investors. Again, because since people thought that housing would always go up, they would think that this is kind of just an asset that you can make profit off of. Now, let's talk about mortgage-backed securities and derivatives. This is pretty complex stuff that we're going into. So like I talked about before, where the banks bundle them into assets and would then sell them. Um, what these were called were mortgage-backed securities. Banks pulled thousands of loans from all over and sold them as bonds. Investors around the world bought them because they're pretty safe. Most people pay back their mortgages because if not, you're gonna lose your house, and you get pretty high. And due to that, there's a lot of them. You're gonna get pretty high returns off that interest. Now, there were CDOs, which are called collateralized debt obligations. CDOs repackaged mortgage-backed securities, mixing high and low risk rounds. So you had maybe you would have someone at the top. You put all your very safe, very low risk mortgages at the top, but as you start going down and down and almost down the pyramid, you get those lower, riskier ones. Um, and then what made this even worse was that credit rating agencies often put these securities at AAA, double A high, even though they were risky. Because again, there is this thought that people pay back their mortgages because no one wants to lose their home. Now there were some agencies, or there were some firms that offered insurance on these assets called credit default swaps. So if there's a mortgage or a loan did default, the sellers of the CDS was on the hook for massive losses, was what this basically meant. And this is really how these financial products spread the risk across the global financial system. When in reality, they amplified and obscured it. And now finally, the bubble burst. This housing bubble that's been growing and growing finally burst. Housing prices peaked and Fed, now that there was economic recovery, they raised interest rates, so interest rates rose, and adjustable rate mortgages reset at higher payments. Many homeowners couldn't afford, now these risky homeowners couldn't afford to pay their loans, and so foreclosures skyrocketed. Just to talk about adjustable rate mortgages, a fixed rate mortgage is you buy it at a rate, and that's not going to change. Adjustable rate means as interest rate change, your payments change. So again, when there's very low interest rates, these risky lower income borrowers could afford to pay the interest on that low rate. But when that interest rose, they can no longer afford to pay it. So, all these foreclosures, all these people who cannot pay back these mortgages, now the value of the mortgage-backed securities and CDOs collapse. As foreclosures skyrocketed up, those skyrocketed down. And banks and investors didn't really know how exposed they were. And really what's important about this, the confidence in the financial system eroded rapidly. People had no trust because look what happened. Now many major investment banks heavily invested in these products, often leveraged 30 to 1, meaning just a 3% loss could whip them out. That's all they needed. Now, moving on a little bit, 2007, 2008 is when the crisis erupts. Several hedge fund collapse, subprime leaders like New Century Financial fail. So many companies I could mention that just went under. There was this idea that too big to fail, and that idea was just not true. When you're so invested into something so risky, and it doesn't go your way, this is what happens. In August 2007, the credit market freezes because banks they don't lend to each other because they don't know if they're gonna get that money back. Now, in March 2008, Bear Stearns, the fifth largest U.S. investment bank in the fifth largest investment bank in the U.S. collapses because again they had nothing, and it was sold to J.P. Morgan Chase with federal backing, but these prices were pennies on the dollar. 2008 is the breaking point. Lehman Brothers, which was founded in 1850, old as ever, goes bankrupt. And this is the largest bankruptcy in U.S. history. Lehman Brothers were just they were so invested. We could talk about Lehman Brothers more. There's multiple movies that cover that you guys should watch that really go into it. Because on the other hand, you have AIG, which got bailed out since they couldn't cover their credit default swap payments. So this is the kind of stark contrast of two companies that failed. One of them, AIG, with those credit default swaps, they get bailed out. But the Lehman Brothers, who were heavily investing in those mortgage-backed securities, they go bankrupt. They don't get bailed out. A lot of that is because AIG, when they get bailed out, they can now cover all those insurance they put out, which because if they fully fall, that even makes it even worse, which is why they ultimately got bailed out. Now Merrill Lynch, another company that's floored. They got sold to Bank of America, pennies on the dollar again. Then Washington Mutual and Wachovia both go under. Stock markets crash worldwide. Biggest crash since the Great Depression again. Now, just to talk about Merrill Lynch, because that's something I know a good amount of. My former teacher, she worked at Merrill Lynch for years, and she left, I believe, 2006 or 2007. And she didn't leave. When she left, it wasn't because she really she knew what was happening. She was this woman's borderline genius. She knew what was happening. That's not the reason why she left, though, because Merrill Lynch was her home, and she didn't leave because she didn't want to abandon her home. She thought her home was gone, meaning that the culture in Merrill Lynch changed so significantly, the leadership changed so significantly that she knew she had to get out of there. It wasn't her home anymore. And that we can talk about that more later, though. Let's just go off a little tangent there. And then now you have the government and the central, which we got into a little bit, the government and the federal bank response. In the U.S., you had TARP, which was put out, which was $700 billion bailout to recapitalize banks and stabilize markets. The government had to come in to stabilize these markets, or it would have been so much worse. The Fed had to go again and slash interest rates to nothing. They created emergency lending facilities and engaged in quantitative easing, which is buying long-term securities to inject liquidity, put money into the market, basically. And if it wasn't for these in the U.S., you wouldn't even know. If it wasn't for that bailout of AIG, you wouldn't even know. And to talk about more on a global standpoint, central banks in Europe, Asia, all over had to coordinate and had the same thing, coordinate interventions into their markets, and then governments launched stimulus packages to boost demand. Now to talk about, again, a more global spread, European banks, especially in the UK, Germany, Iceland, they suffered huge losses. Global trade and credit flows collapsed because there's so much uncertainty of what was going on that it's the same thing with those U.S. banks who couldn't lend to each other because they didn't know what was happening. That was worldwide. Stock markets fell by 40 to 60% worldwide because, again, all of this the fact that these mortgages were being sold put everywhere. If any investment bank, had these, were buying these, and these investment banks loan out, so that makes it worldwide. Um, Global GDP shrank for the first time in decades because there's so much uncertainty that people that weren't trade, so each companies weren't, or my bad, nations weren't, they were losing because these companies didn't have the trust to trade internationally or domestically, meaning that output goes down and of course GDP goes down. The unemployment soared over 10% of the US or higher in Europe. Aftermath, you have, of course, the Great Recession, millions lost homes, jobs, and savings, long-term impacts. Eventually, there was slow wage growth. Um, and public distrust in financial institutions because they destroyed that by what they did. Now, of course, there were some regulatory reforms. In 2010, there was a Dodd-Frank Act in the U.S., increased oversight of financial institutions, created the Consumer Financial Protection Bureau, and regulated derivative markets. Basel III, international banking reforms, tightened capital requirements. And now, just to compare this a little bit to the Great Depression, this isn't that type of video, but just to some obvious comparisons you have here. On regulation, crash, regulation. You see that. This housing market's very unregulated. They can pretty much do what they wanted with that. And then grow. Like the boom in 20s, growing, low interest rates, a lot of borrowers. And then all of a sudden, there's a burst, whether it be Feds raising rates, distrust, and then or if we flip over to a seller's market and then burst, and there's huge recession, huge economic downturn that's globally felt. And in response, and in the response, government has to implement programs to bail out companies, even just to give people jobs, to put money in the market. And in the aftermath, there's more regulation, especially for banks. Now, U.S. did gradually recover due to a loose monetary policy. This did lead to a raise of public debt or government debt because government, the same way that companies loan the government loans to give the money that the companies need. It's kind of crazy. And then this crisis fully changed the perception of capital. I wouldn't say that, but the perception of regulation and financial ethics. There was a lot more. The public wanted a lot more regulation over companies, so that something like this wouldn't happen again. And then financially making these risky trades or putting people in those positions were very now looked down upon. Again, what happened. And now again, my favorite part of every episode, we're talking about who succeeded in this, because I do hate, talking bad, we get something good, because that's something. There's always going to be something good to pull out of anything. I love doing that. I love pulling the good out of the bad. So, what big company could possibly succeed in that financial crisis, 2000 financial crisis, Great Recession? Who? J.P. Morgan Chase. Now, when the financial crisis hit, many were exposed to those MBSs. But J.P. Morgan Chase under Jamie Dimon not only survived, grew stronger, and became the bedrock of financial stability. Now, why did they succeed? They had very conservative risk management. Under the leadership of CEO Dimon, there was a very cautious strategy. Before the crisis, Diamond restricted the firm's exposure to these subprime mortgages and complex derivatives. Then you have their discipline. JP Morgan had one of the highest Tier 1 capital ratios among other U.S. banks, meaning had more of a financial cushion. And then they avoided over leverage. The bank maintained lower leverage compared to competitors like Lehman Brothers, aka they didn't put all their eggs in one basket. They didn't fully trust this what they knew risky MBSs were. Now, very famous quote that I want to sleep at night. I don't want to bet the company. Demon famously told traders before 2008. And then, so that's how they were able to weather the storm, but how were they able to succeed in it? They took advantage of those who failed. We talked about Bear Stearns in 2008. They bought them with help from the Fed. They took advantage of the fact that this companies couldn't afford to fall under for the Fed. The Fed doesn't want to have to bail out everyone. So with the Fed's urging and Fed's help, JP Morgan acquired them for a fraction of the pre-crisis value. And then Washington Mutual was again bought by JP Morgan, which expanded its deposit base. The outcomes of this, JP Morgan stock recovered far faster than other major banks. So it was hit, just as every company was due to the fact that they weren't over-reliant, the fact they were cautious in what they did buy, meant they were able to bounce back a lot quicker. Again, these acquisitions made it the largest bank, U.S. bank by assets. And public perception, again, people saw it as someone you can actually trust, which made it one of the few Wall Street firms whose reputation actually improved after the crisis. And then, again, by 2010, strong bounce back, strong profits, and they were succeeding. Now, we talk about some failures, we talked about success. What can we learn? What do we pull from this? One, build from the long game. Build yourself for the long game. Focus on making yourself a person who's ready for the highs and the lows. Not just someone who just jumps on the next big thing. Be able to see down the road, not just what's in front of you. Because everyone that saw this great thing that they could jump on, what happened? Secondly, know, then go. In business, you can't make a decision until you fully understand what the topic is, what it is that what the decision is, the impact of the decision. JP Morgan, they were able to they were able to understand what the risks were. They were able to understand that they shouldn't be overly reliant on it. So that allowed them to not be as hardly hit. Now imagine in a perfect world that they fully understood what the breakdown of those the breakdown of those mortgage-backed securities, and fully understood that those bottom very risky, and then understood that the Fed with an improving economy are going to raise interest rates. And this crisis could have been avoided, to be honest. Finally, don't expect help. This one is a little harsh, I understand. But it's true. When you're struggling, don't expect someone else to pull you out the fire. Be ready to do that yourself. Lehman Brothers, they expected a gov bailout. They expected someone else to jump on them. Didn't happen. And what happened? They went under. Be ready, be able, and be willing to pull yourself out of the fire and come back stronger. JP Morgan, they took a little bit of a hit. Bank of America took a little bit of a hit. One of the reasons that they succeeded and they survived, they took charge of their own fate. They didn't lay their hands, lay their fate in the hands of government, lay their fate in the hands of another company. They said, all right, this happened. Now let's get out of this mess and let's come back stronger. Adversity creates strength. All right. And finally, talk about Merrill Lynch. And as I've said before, understand your culture. Understand what's going on around you. You see something like my teacher saw, you see something off, you see one of the reasons why your firm, your whatever is so successful, you see that change despite all the work you put in, and you're in a position where you can't change that, get out. Get out. So many people. And you gotta understand, she was a woman all Wall Street on a time where that wasn't as the norm as it is now. The amount of people, and she had a lot of friends in Wall Street. You know, all these other strong women who weren't able to recognize that culture change, they were so successful and so trusting that they thought that we could weather the storm. She was getting calls about how these people who were huge spots on Wall Street couldn't pay the bills. And it's very sad. Because it's very sad. Why? Because a lot of people at the time were taking bonuses and et cetera as bonuses and stocks and stake of the company. So when this company's growing, that's great. When the company falls, and gets sold for pennies on the dollar, you lose so much money from that. It's sad, but again, to wrap it up on a happy note, put yourself in the long game, know then go, don't expect help. I hope you guys like a little change up in the episode. Hope you guys are able to learn something that you can apply in everyday life. That's our goal here at Pass Meets Profit. And I'll see you guys soon for the next one.